The Bajaj Finance Q2 FY2024 earnings conference call will begin shortly. If you would like to ask a question, please press star followed by 1 on your telephone keypad. Thank you for your patience. Ladies and gentlemen, good day and welcome to Bajaj Finance Q2 FY2024 earnings conference call hosted by Morgan Stanley. This event is not for members of the press. If you are a member of the press, please disconnect and reach out separately. For important disclosures, please see the Morgan Stanley disclosure website at www.morganstanley.com/researchdisclosures. Please note that this call and your questions will be recorded and may, in certain circumstances, be distributed to clients and/or made publicly available. By participating in this event, you consent to such recording, distribution, and publication. All participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. I will now hand the conference over to Mr. Subramanian Iyer from Morgan Stanley to begin. Thank you, and over to you, sir.
Thank you, Nadia. Hello, everyone. This is Subramanian Iyer from Morgan Stanley. Thank you very much for joining us for the Bajaj Finance Q2 FY24 earnings call. To discuss the results, I'm pleased to welcome Mr. Rajiv Jain, Managing Director, Mr. Sandeep Jain, Chief Financial Officer, and other senior members of the management team. Thank you, Rajiv and Sandeep, for giving us the opportunity to host you. So without further ado, I now invite Rajiv to take us through the key financial highlights for the quarter, post which we will open the floor for Q&A. With that, over to you, Rajiv.
Thank you, Morgan Stanley. Thank you, Subbu, for hosting us. I have with me a set of my colleagues here, Anup, our Executive Director, Rakesh, our Executive Director, a few other senior colleagues in the room here. I'll take you through the investor deck, which has been uploaded on the investor section of our website. I'll refer to that. So without taking too much time, let's just jump right in to panel number 4, which is our executive summary. So I would say good quarter across all financial and portfolio metrics. AUM grew by 20,167 crores. We booked over 8.5 million loans in the quarter that went by, added 3.58 million new customers. And the Bajaj Finserv app now has just a tad below 45 million customers. Overall AUM crossed 290,000 crores to end at 290,264 crores, growth of 33%. OPEX to NIM continues to hold at 34%, which is really where it was last quarter as well. PAT grew by 28% to 3,551 crores. ROE crossed the hurdle rate of 24% to come in at 24.1%, and net NPA remained pretty steady at 31 basis points. If you move to the next panel very quickly, I won't make all the points, but I've talked about AUM growth, I've talked about AUM, new loans booked I've talked about. B2B disbursements grew by 31%, came in at 18,610 crores on a year-on-year basis. New car financing business has gone live. We are now present in 85 locations. We are quite excited about the business that's the way it's kicked off, and festival season is anyway right here. Microfinance pilot got launched on 1st of September. It's in a pilot basis in 12 villages in India, in UP and Karnataka, and 100 locations are on track to go live by March 24. And all goes well, next year we'll have 300 villages in India by March 25. Customer franchise, I talked about it, 3.6 million addition. Over the first half, we've now added 7.42 million customers, new customers to the franchise. Franchise is at just a tad below 77 million customers. I think we're pretty confident that we'll add this year between 13 and 14 million new customers. Added 106 locations to the overall location footprint, and now at 3,934 odd locations. Liquidity buffer stood at 11,400 crores, so remain pretty strong. Q2 cost of funds came in at 7.67%. Sequentially, it grew by 6 basis points. Deposits book, so liability focus remain as strong as the asset side, grew by 39% and 250, just a tad below 55,000 crores. Operating efficiencies, so overall NII grew by 26%. NIM compression in the quarter was 14 basis points on a sequential basis. OPEX to NIM continue to hold steady, as I said earlier, at 34%. Employee headcount crossed 50,000 people. We added 4,500 people, and annualized attrition at this point in time is at 13.5% versus same time last year when we did not publish this metric, it was 18.6%. So clearly, we are headed in the right direction as a company on employee attrition as well. Credit cost came in at 1,077 crores. We released 100 crores, 100 crores of management to macro overlay was released in the current quarter. Okay, it's right there. GNP, NNPA pretty strong at 91 basis points and 31 basis points. You can see a movement of 4 basis points sequentially and 3 basis points. It's just daily DPD frame rather than anything else. That if you have any question that Sandeep can answer later or Fakhri can answer, but there's no movement there except for days. So it looks the best in the fourth quarter. Just to give a texture, it looks flattish in the second quarter. It looks
flattish in the first quarter.
Flattish in the first quarter.
And then Q2 has the noise of 92 days in a quarter, resulting in higher flow of GNP.
Quarter 3 is flattish. So Q1 and Q3 are flattish. Q2 is a little elevated, and that's how it will be every year. And Q4 is better. So that's how the daily DPD moves. So you will see that it's very marginal, but just to make the point. Stage 3 assets, as you can see, continue to be in the right direction. Risk matrix, except B2B businesses, remain all green, except B2C, which is yellow. Bajaj I've talked about, PBT I've talked about. Annualized ROA came in at 5.16% as against 5.41%. Mainly NIM compression, which is slowly bringing it back to pre-COVID levels. Overall, on a full year basis, we feel that there will another 20-25 basis points of 30 basis points of NIM compression that will happen between operating leverage and so on and so forth. We should be able to sustain a 5% ROA on an exit basis as we deliver the full year. Capital adequacy remains strong at 23.2%. Tier 1 capital of that was tad below 22% at 21.88%. Just two updates. I mean, you're aware of this. The board of directors has approved raising capital to the extent of 10,000 crores, 8,800 crores through QIP, and 1,200 crores through preferential allotment to Bajaj Finserv, to the promoters of the company, which is Bajaj Finserv. So that's just one update. And second being Finance Technologies, in which the company is entered into a binding term sheet for acquisition of a 26% stake in the company for an aggregate amount of 267.5 crores, valuing the company at 875 crores. That's quickly. I'll just jump quickly to omnipresence update on page 11. All metrics are moving in the right direction. Download 16.5, 17 million in a quarter. Net installs are 45 million. In-app programs 134. Remain among the top 5 on Google Play Store. 35% of service requests are now coming through consumer requests. Service requests are coming through the app. UPI handles, bill payment transactions, they're all moving in the right direction. We continue to remain highly focused on app and web metrics, and the momentum remains pretty strong. I think that's on panel 13 quickly. No, panel 13. Just on key financial metrics, next man. Yeah, panel 14, sorry. 13 or 14 for them? 14. On panel 14, pretty much very steady. As you can see, H1 FY24, 62,195 rupees is AUM per customer. PAT per customer is just a tad below 1,500 rupees. Cross-sell franchise moving in the right direction. All metrics are moving in right direction. We remain pretty comfortable with the ability to mine the franchise and continue to generate similar outcomes as been so, as you can see on this panel, for the last 7-8 years. Jumping right quickly to end of it, so that I can open it up for questions on portfolio metrics. As you can see, all of them, two panels, 52 or 51? 252. As you can see, everything remains within the corridor. Consumer durable lifestyle, 99.51 current. Two-wheeler, three-wheeler, 94.71 current. Digital products, 99.41. Urban B2C, 98.7. So all of them remain better than Feb 20. Other than, while even rural B2C, move to the next panel. Even rural B2C is just a tad below where it used to be in February 20, but we, from a management assurance standpoint, as you can see, the stage 2 used to be 110 basis points, it's 140 basis points, and that's why it's a yellow. Otherwise, in general, we are pretty comfortable on all credit metrics. Just one last point I wanted to cover on PPC. We've added a new panel, which is panel number 41. It's a new panel that we've added. This used to be earlier there 5-6 years ago. As our product portfolios continue to move, as various products have gotten added, whether on lending side or on the payment side, it was a question from various investors that how is your PPC being moving. I'll take 2 minutes to make the point. There are 4 key blocks in which our product per customer is broken up in. Lending, all lending products of the company. Distribution of products and services, all value-added products and services of BFL and partners. Deposits, it's fixed deposit and systematic deposit plan, which is FD, and payments is any one of them being bought by a customer as taken as one payment product is really how they've been slotted. As you can see, as of 21, we used to have 5 products per customer, and there used to be 2 colors. As of FY23, there are now 3 colors. It has moved from 5 products per customer on the left-hand side that you see to 5.81 products per customer. As of first half of the year, at this point in time, it's looking like 5.97 products per customer. 35 to 40 basis point, 0.4 is now payments product. On the right-hand side is as customers get onboarded, principally how do they move in 12 MOB, 18 MOB, and 24 MOB is as they complete. So if we are originating more and more customers, the left-hand side will look a little suppressed. But as so both have to be looked at, that in 24 months on board, because in the last 18 months, principally we've onboarded 19 million new customers. Last year was 12 million customers, and this year, first half is 7.5 million customers. That's 19 odd million customers. So as their mind and as they warm up to, they become more engaged using digital assets and otherwise, their take-up rates improve. So that's, look at both of them independently is the only point. With that, I have come to the end of my points that I wanted to raise. Happy to answer any questions between me and the management team members. Subbu, over to you.
Nadia, I think we can open the question queue.
Of course. Thank you very much. We will now begin the question and answer session. If you would like to ask a question, please press star followed by 1 on your telephone keypad now. If you change your mind, please press star followed by 2 to withdraw your question. When preparing to ask your question, please ensure your phone is unmuted locally. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. Our first question goes to Antariksha Banerjee of ICICI Prudential. Please go ahead.
Hi. I'm audible, right?
Yeah, you're audible. Very much.
Thanks, Rajiv. Two questions. One is, starting from the point that the rural B2C is still flagging red, and I think last quarter we had spoken about some analysis that we were conducting on the leverage of customers and how that's moved. Any update you would want to share on that, and any portfolio actions that you have updated since then?
Yeah, so we wanted to really publish. We are ready, but principally, Bureau technically did not allow us to publish that, rightfully so. But we can share some update. I mean, we want to publish it. So look, the way it's looking like is if you take 20, 22 and 23 in terms of count of loans that India was disbursing across all personal loans have grown from 4.5 odd crores to by 22 it had gone to 7 odd crores to by 23 it had gone to last year it was 10.5 odd crores, 10.7 crores to be precise. The largest growth principally it seems was in less than 50,000 and in 8 lakh plus. Okay, just at a frame level. That's level 2 input for you. On an AUM basis, however, the less than 50,000 contribution to the total, and the total AUM looks to be like 13.5. It grew from 7.5 lakh crore in FY20 to around 13.5 lakh crore. Okay, treat this data as 98, 99%. So take it at a trend line level rather than with a 1 to 3%, if I may say so, adjusted for adjusted. Otherwise, directionally these numbers are so 7.63 lakh crore has moved to 10.5 lakh crore to 13.5 lakh crore. What it principally says is that at the industry level, the 93.73% of the total balances of 7.6 lakh crore used to be current in FY20. That number in FY22 was 91.75% current, and that number in FY23 is 92.21% current. Industry level, okay, this is industry. When we look at that versus us, we look like in FY20 we were at 98.2% current. As of 22 we were 97.12% current, and as of 23 we are at 98% current. And if you look, so we've done when we look at this data, what it also told us is that less than 50,000 is really where a lot of corrosive outcomes are. And what level 2 it told us is that principally those who have more of them doesn't mean they are more leveraged, but those who have more of them are more leveraged, are more imprudent. Sorry, not leveraged. I clarify and I re-emphasize the point. They are not necessarily more leveraged, they are more imprudent. So what we have done is we have cut between 8 and 14% of the business in urban and rural, 14 in rural and 8 in urban as a preventive measure to those who have more smaller ticket loans, while they may be short-term in nature, represents imprudence. So that's really, we would have liked to publish this data because it would help, it will help you guys. But for technical reasons, we could not publish this data.
Sure. But Rajiv, is it?
I want to make a last point. Since we are fully seized of it, we are looking at this data very closely on a month-on-month basis and taking decisions to ensure we continue to protect the credit risk and portfolio risk in the company.
Just two call-out from my side. I think as Rajiv called out at the beginning of the call itself, take the data with pinch of salt at this point in time. This is based on our internal analysis of how we understand the data to be. That's point number one. Point number two is the portfolio health that Rajiv referred to. We have taken into consideration customers with no delinquency all the way up to 179 days overdue.
80 days.
Customers beyond overdues of 180 days past due we have ignored because the write-off policies to various action that respective banks and NBFC would take, we are not privy to that. So for comparison point of view, we have only considered customers from no delinquency up to 179 days overdue.
It's an important call out, so take this data from it.
So this
we are doing this exercise for all portfolios. Let me make that point. It's not just for unsecured. We're now doing, because the overall supply side, as I keep making the point, across asset classes has increased significantly. So it's not just for unsecured. This principle applies to all our product lines, and we've acted across product lines as a company to make sure that this improvements and it shows up. So you may have a home loan with 3 BNPL and I don't have, shows up that if you have 3 BNPL, your default rates look to be 2.5x, even for a home loan. Just as an example to make the point.
Got it. So
Sorry,
just
go ahead.
small follow-up, Rajiv. Based on this exercise, do you conclude that the larger ticket, the 8 lakh plus, or even maybe the 5 lakh plus, if it is more overlapping with our customer base, despite having grown so fast, is relatively less of a problem, at least at the point?
So if you look at 8 lakh plus, in FY20, the number looked like 291 basis points. 8 lakh plus in FY22 is looking like 90 plus, I'm talking, is looking like 128 basis points, and 8 lakh plus as of FY23 is looking at 115 basis points. This is industry. Okay? We were 28 basis points. In FY20, we were 31 basis points, and we are at 18 basis points. So yeah, we do conclude that adjusted for less than 50,000 numbers in general of greater than 51,000 and above are looking lower than FY20.
Got it.
Yeah.
Sure. Thank you. I'll just have one other different topic and I'll not take much time. This is regarding the capital raise. I just wanted to understand what are your plans of utilizing this capital in the mortgage business versus the non-mortgage side of the business, especially given the fact that the housing business is supposed to list separately as per regulations.
I mean, so principally that listing is 8-9 quarters away. As of now, it's 8 quarters away. I have said in public domain that we have formally requested for extension. That's point number 2. It's principally capital adequacy, as you heard me, was 21.88%. Strong growth in both sides, both BFL and BHFL. H1 24 momentum, if I look at it, has been the strongest that we've seen in last 4 years. We virtually added 43,000 crores on a consolidated basis. Even BFL is launching a whole lot of new lines of business, right? Non-Bajaj Auto has gone live. We are now doing 20,000 non-Bajaj Auto two-wheelers a month. LAP in BFL has gone live. New car financing has gone live. MFI pilot I just talked about. Tractors going live on January 1. Emerging local corporate in BFL going live in December. So clearly there is action on both sides of the balance sheet, and we are prudent allocators of capital. So at a fundamental level, all I can tell you is we'll prudently allocate capital, and those who generate the sustainable return on equity would get capital for all our lines of business. I don't mean entities. I mean those, and we are very capital prudent and very. Lastly, I think since you talk capital raise, we've always raised capital and consistently demonstrated our ability to effectively deploy it effectively and deliver medium-term ROE goals. So even while we have 1 year to raise capital, even as we raise capital, we are clear that the short-term stroke medium-term goals of ROE hurdle rate that we established will not be compromised in any given manner.
Sure. That is well appreciated, Rajiv. Thanks for your time.
Thank you.
Thank you. And the next question goes to Viral Shah of IIFL Securities. Viral, please go ahead. Your line is open.
Hello. Yeah, congrats, Rajiv and Sandeep, on good numbers. So while you answered the first piece of my question on leverage, just wanted to clarify that is it possible to do that, if not now, but maybe next quarter once the capital raise is done, if that is a constraint for putting out a data in terms of leverage at the customer end?
We'll try and work closely with the bureau because it's in the we are not the constraint. We'll work with the bureau and try and assist.
Okay.
Maybe if they deem appropriate that you guys can reach out and work with them, that's also probably we would assure you that we'll try our best.
Thank you. And just incrementally on the other piece of question is within the housing finance subsidiary. So right now the mix of home loans, LAP, it's actually sub 60%. And because of the opportunities out there in the market, I think we are seeing opportunities in the developer and LRD segments. But what's the time frame over which you have to reach 60%?
Is Atul here? I'm Atul here, so I'll answer this question. So regulatorily, we are required to have a 60% asset mix by 31st March 2024. That's a RBI guideline. And against that, as of 30th September, we are at 59%. See, the definition of a residential housing varies as per the regulation. So that includes 50% of an individual home loan, which has to exclude top-up. When you see the published figure, when you see at a home loan at 56%, actually the home loan, individual home loan, which is excluding top-ups and the other that component is roughly around 51%. Then up to 10% you can have a CRE RH, which is called a amount lent for construction of residential dwelling unit. So when you add both, as of today, as of 30th September, we are at 59.01, which is very close to 60%, which is required to be 31st March 24, and we intend to meet that from the before the regulation given time.
Okay, so fair enough. So there is not going to be any incremental material delta from there in terms of mix change even from now.
Yeah, because right now it is 59.01, so 59.01 has to move to 60%, and that we have a good 6 months. Our attempt would be that before up to 31st December, which is Q3 itself, we should be reaching that number of 60%, what is required on 31st March 24.
Got it. And just one on last piece of question, Rajiv, was in terms of when I look at those panels for different products, so what I see is that for some of them, the stage 2 has come down and probably the stage 3 has gone up. So whether you look at B2C, so this is the phenomena that you were referring to earlier, right? Nothing incrementally to read into it.
Yes, this is the exactly thing that we are referring to.
That's panel 49.
The customers were stuck because of day past due logic into stage 2 in the last quarter. And because of 92 days quarter, that is 31 days of July, 31 days of August, and 30 days of September, these customers have moved from 89 days to over 90 days in the current quarter.
Okay. And this it should correct in the third quarter, basically.
Yes. Third quarter, as Rajiv explained, it will be a normalized quarter. Some noise will come in Q4 again, where because of number of days in the quarter being lower, one may see 1 month of skip in terms of GNPA classification.
I just want to clarify to everybody that because we bank on second, it's important.
This phenomenon is pretty specific to us because in most of the businesses, the banking due date for the customer is second of the month. That creates this anomaly of customer getting stuck to 89 days at times in a given quarter.
The 99% of our banking across the entire 23.5 million customers banking, we would be today on the 2nd of the month.
Okay. So just to get it right, so in the quarters where the number of days are higher, you will see the more slippage into stage 3, right?
Yeah, and this is specific to Q2. Fortunately, we have only 4 quarters in a year, so it can't be more than 1 quarter. So this is specific to Q2. Q2 normally ends up losing out, and Q4 happens to be gainer because of days past due logic.
Got it. Makes sense. Yeah. Thank you. That's it from my end.
Thank you. And the next question goes to Piran Engineer of CLSA. Piran, please go ahead. Your line is open.
Yeah, hi. Thanks for taking my question and congrats on the quarter. Just wanted to understand, your NPLs in B2C, both urban and rural, are pretty much similar, but, we have green in one and yellow in one. And same thing for SME, which is an unsecured product, at NPLs of 1.25%. So I just wanted to understand why we treat them as different in terms of our outlook. And secondly, will we expect, like we've seen growth in rural B2C slowing down this quarter, will we expect it to slow down in SME and urban B2C next quarter onwards?
It's purely data dependent. At this point of time, the only place where we have a stance of, in fact, let me make a point, and I made that last quarter, that principally rural B2C slowed further. It grew year on year, first quarter 17%. Actually, you saw the numbers 20 when I had clarified it had gold loan. In second quarter, it's actually grown only 12%. So it's pure data dependent as we feel. Now, that's one part. Second, as I said, that technically I can tell you it's green, but we are exactly stating the greens and the yellows and the reds are management assurance. What do we assess the position to be? That's an important point, is what I would just want to make to you. If you go to urban B2C, okay, you saw stage 2 at 143 basis points and 95 basis points. Okay, whereas here it's 109 basis points and 141 basis points. So and leave even the number. It could have been even 109 or 120. It is possible we may have still given management assurance at yellow. I think that I just want to clarify that.
Sorry, how did you get 95? I thought it was 1.19. I'm looking at slide 48. So am I reading?
You're looking at GNPA.
I'm looking at stage 2. I'm looking at go to 51
okay.
and 52, which is really where we provide management assurance of. This is so if you see urban B2C panel 52, you have to see. Okay. You see 143 basis points and you see 95 basis points. This is urban B2C. If you see the next panel, which is rural B2C, you'll see 109 basis points and 141 basis points. And you're starting to see it come off. Okay, so it's possible by February or so, the business would start to grow again. Is really how we see. Sandeep, you want to make it?
Yeah, I think there are a couple of things.
No, I think the only confusion is slide 48 and 52 because 48, when I just look at the numbers numerically, okay, fine. This is GNP and you're referring to stage 2. Fair enough. Sorry, carry on.
And I think, Piran, one more thing.
Moves to GNPA, always. So the early matrix is what is a current, what is a stage 2 and then stage 3. In our business, we like to catch things in early buckets rather than in late buckets at a philosophical level.
Yeah. And I think, Piran, what you're seeing is position on a given day, which is for respective quarters. We are also looking at eventual flow into losses. So what you are not able to see is the bounce rate, you are not able to see collection efficiency, and the eventual loss that's flowing in the P&L. Based on that, we also determine whether a particular business should be tagged as green or should it be tagged as yellow. At this point in time, we believe rural B2C should be tagged as yellow and we should take corrective action, which we have already taken.
And growing a lot more slowly, because that's what we can do.
And maybe probably one quarter from now, if we find things are looking better, the internal portfolio bounce rates, efficiencies, and flow to losses are looking better, we may restart growing the business back again.
Got it. And just secondly, on your LRD book, and that's been a strong growth driver, can you just give us some more color on the book in terms of, how much of it is, say, malls versus offices, or who the type of landlords are, etc.? I know in the past you said that it is even safer than land.
Name?
But, name. Okay, that's fine, but some comfort around it. Because it's grown to like $2 billion now.
So I'll give you the complete texture. Now, so what we do as a LRD product, we, by definition, we generally don't do retail malls. We do generally a grade A commercial. It's a 12-year-old business for us. We had been doing earlier there, and we have always seen an impeccable behavior. Now, on a basic guardrails, generally mall and the retail malls are not done. It is except barring one exposure, which is at a REIT level where we have a retail exposure. The business has always been 100% current for us, irrespective of the size. It is generally the rentals are to Fortune 500 companies, mostly to MNCs in the IT sector. It's a grade A commercial. So 100% of the portfolio largely would be grade A commercial, with retail being only one, where the large corporate is there, which is a REIT exposure, which is a REIT non-grade A commercial office space. Lessees are all largely Fortune 500 companies, and all cash flows are escrowed by a normal definition as a escrow to the receipts in escrow to the discounting the EMI requirement. We have a clear buffers of close to 30 to 40% kind of a buffers from it happens, and that escrow compliance is strictly adhered to. Just to give you a total comfort.
Last point. If there were ever butterflies in the stomach on this business, that was March 2020 till March 2022. So because we thought work from home is the new future, what would happen to this portfolio? This portfolio, even between March 20 and March 22, we did not see a single instance of default. If there was ever a event that those 24 months were the test case much harder than any other portfolio for this, because they were all empty and renters had to keep coming.
So one last data point on this to give more. Our total vacancy in our LRD portfolio is 1.6% against a total commercial market vacancy of close to 15 to 16%. So the vacancy levels, even this, and we normally have a large cushion in the cash flow to there. The total vacancy at a portfolio level is 1.6%.
Because we get to know through
the escrow receipt.
Absolutely.
Got it. Okay, this is very useful. Thank you so much, and all the best.
Thank you.
Thank you. And the next question goes to Abhishek Murarka of HSBC. Abhishek, please go ahead. Your line is open.
Thank you. Hi, Rajiv and team. Congratulations for the quarter. So, just one question on this NIM guidance. So, you said another 30 bips of compression to go, mostly due to an increase in cost of funds, and pretty much unlikely that you'll see any kind of yield compression here.
Abhishek, yes. I think if you look at the overall interest rate curve, it's significantly volatile in recent times. This is based on our assessment of situation as of today. We believe cost of fund is heading northward. Of course, as I said, volatility has remained in place for quite some time now. I think the bigger thing is replacement of old monies that get borrowed for 2-year and 3-year at very, very low price. They are coming from maturity and renewal. As the renewal takes place for us and for the industry, the cost of funds are set to rise. And I think a significant portion of them are coming from maturity between next quarter and probably early part of Q4.
So I think it'll peak out by Q4, but clearly second, third, and fourth quarter, we will see replacement as the largest driver.
In fact, if you notice, in the current quarter, the movement in cost of fund was quite marginal, but I think it will catch momentum in Q3, probably.
Got it. And very unlikely that you would have space to increase yields from here in any of the segments.
Yes. We never diluted. The answer is yes. Other than our variable businesses, variable businesses being 32-33% mortgages. That's one part. To the commercial balance sheet, which is 7%, that's 40%, and another 5-6% is LAS. So 46% of the balance sheet has variability. Rest of the balance sheet, of course, competitive activity may not allow us to, but just from a variable to fixed balance sheet component standpoint, 54% is fixed and 46% is variable. But staying with the last point, I would say, and that's really where we've been continuing to invest in building in our digital transformation, in omnipresent strategy, and as I said, over the last 2 quarters, we have peaked out. So clearly, operating leverage will start to play through. It's playing through already for the last 2 quarters. It'll start to play through more so as we move from here. And there would be a moment when we'll further accelerate expansion, and for the next 2 quarters, we do clearly see operating leverage to play a bigger role in mitigating the NII compression.
And Rajiv, in your OPEX, so that was my second question on OPEX, what is the extent of the discretionary element? So out of, let's say, quarterly 3,000 crore kind of amount, how much is discretionary which you can run down, apart from banking on operating leverage to drive down the cost ratios?
Look, I keep saying to people, we are an entrepreneurial company. If I don't want to spend the money, I don't want to spend the money. I mean, 45% is fixed, right? That's compensation, right? That's salary. The rest I can argue with you 55%. I mean, I'm just theoretically, can we squeeze out, and we did that, right, in pandemic. I want to make, and so it's a philosophical point rather than how much can be squeezed point. We remain a growth company, so it's not like we got to, go back to the pandemic days where we really worked hard on squeezing cost out, but we are a lot more optimal or optimizing cost more that we are in at this point in time. So is all I would just say, Abhishek.
Okay, sure. And just one quick question on this Pennant Technologies, if you can shed some light on how exactly it helps, what are the plans there?
Rakesh and Raghu. Rakesh.
Yeah, go ahead. Come close to the mic. So relationship with Pennant actually goes a long way back.
Louder.
Yeah. I was just mentioning that you would have read also that it's a strategic investment. Our relationship with Pennant Technologies go a long way back. In 2016 it began, and it is strengthened year on year, and we are at a stage wherein we are migrating our full core back-end loan management application onto Pennant Technologies. So being a core platform and our partnership being quite good and the founders running the company quite well, there were a lot of dimensions which made it imperative for us to invest into Pennant Technologies. As you understand, the scale at which Bajaj Finance operates, we required a very robust platform. Our multiple group companies also use the platform. Bajaj Housing Finance uses it. The full end-to-end lending suite of Pennant Technologies and a couple of more companies are also planning to go. So at a group level also, it really made sense for us to do investment. And finally, we don't move technology investments on a financial basis. It's more of a strategic business, what we intend to do. With the owners and the founders having the free hand on running the company, and we providing them the strategic directions and the tools which were created at Bajaj Finance and the playbooks that we at Bajaj Finance will help the company move forward. That's essentially
it's strategic for us and it's strategic for them.
Anurag and Sandeep, you want to add?
Is the second order point that Rakesh was making. So it's strategic for both. It's not just strategic for us. Clearly strategic to us as it becomes a core lending platform for us. We've taken our time. Core lending platform need to be really solid, need to be really resilient for us to take the decision to move. So we move product by product over long periods of time. I think that's just one to re-emphasize the point. And two, we clearly intend to help them build a roadmap for them as a company to become from a what I would call a small-sized company to a medium-sized company and hopefully someday a large-sized company so that we also create value for them and for us. So that's the twin objective.
Got it. Thanks so much. Thanks for all the answers. Thank you and all the best.
Thank you. The next question goes to Concall Shah of Oaklane Capital Management. Concall, please go ahead. Your line is open.
Hey, thanks for this opportunity, and my questions are two. Rajiv, we have started investing upward of 200 crore in several companies, RBL, MobiKwik, today Penn Technology. So I'm sure some of them would be a strategic partnership, some would be growth enablers, some would be learning cost, low-cost experiments. But given the 24% hurdle, what's your view and outlook, and more importantly, what is the quantum of investment we as investors can expect going ahead? And secondly, on mobile, can you share some statistics on the quantum of origination, failed journeys or drop-off rates, DAU, MAU churn, etc.? Anything you can share with us on the mobile?
MAU is around 21 million. That number I know. Okay, we don't publish it. We can publish reams of data. It will confuse you guys. So out of 45 million net installs, the MAUs are anywhere between 20-21 million. And that number is growing. Okay, 90-day install ratios rates are 78, 77, 78%, 76, 77, 78%.
Around 2 million.
Daily active user, as Rakesh is saying, is around 2.5 million. So, and as the payments start to play through, we will see more adoption happen. On drop-offs, etc., Kuntal, these are journeys. When I say journeys, the digital transformation, we are very clear that we run two companies now. We run a offline world and we run a digital twin. And I do now realize that why is it so hard to pull off in a company a digital twin and a normal twin. So clearly it's a journey. And since you raised the point, I'll make the point that the way you see today the asset is going to go through a dramatic change in the next 9-12 months' time. I mean, we are off to what I would call a phase 3 transformation of the entire asset. And it's not that you will see it in 9 months, you will see changes happen every quarter. Because when we built this asset in December 21, it was based on imagination. Now the asset is being built on data. Okay, so that's the fundamental shift. We had imagination about building the asset. Now we have a clear view on what leads to a rage index, and I can go on and on. Okay, so it's now being built on data. The entire phase 3 infrastructure that's being created is based on hard customer experience data. Okay, so those are some 2-3 points to you on. Now on investments. One, we are very prudent about what we do. This is the first investment that we made was MobiKwik. We learned a lot from them. We didn't know mobile technology. That investment, principally, if all had gone well, would have made significant money for you as investors and for us as an investor. Someday, we clearly do believe still that there may be value in that investors will value the business. So that's one part. Second was RBL, and we remain invested. They are a strategic partner of ours. We have 3.5 million cards that we have helped create in our partnership. It's a strategic partnership, and we've onboarded 5.5 million credit cards over a 7-year journey with them. Plus minus, I think I may be seeing 2 to 3 lakh. 4.8 million, as Manish is clarifying, 4.8 million ever cards onboarded, and we have 3.5 million cards relationship with them. And as they transform the bank, hopefully, the investors would, we as investors and you as further investors in us would realize value. The third investment we made last year was Snapwork. That is a small investment. The fourth investment we made is Penn Technologies. We have slotted our investments principally in 3 areas of application development on one side, second is products, and third is emerging data. One investment a year is really what we think we can consume, absorb, or work with. So that's really how. So only thing I want to assure you, we'll remain very prudent in the way we make investments, because we realize it's hard to make money, it's easy to spend it, and they are strategic in nature, and they go through a very rigorous process before being approved. So our investment case rationale remains reasonably high and is one at a time. Does that answer your question?
Yeah, thanks. And just one last question. Can you care to comment on RPA and the impact on OPEX, the way you visualize going ahead in next couple of years?
RPAs now, people will, okay, Anurag is saying I'll answer, so let him answer. So Kuntal, we'll stop using RPAs.
Yeah, absolutely. So RPAs are replacement to the APIs that we use. RPAs is a very short-term bridge that we use. In case the API development takes time, we deploy RPAs. Once the API development gets completed, the RPAs get sunsetted. So our preference is to remain on APIs which are far more scalable and far more configurable rather than RPAs, which continues to keep changing as the UI UX undergo change. So our preference is to go more towards the APIs in the RPAs.
And on the second of the month, which I made an earlier point on, because we bank 23 million installments, in general between second and third we see 200 million odd API hits on those 2 days, because people want to come and check whether they got debited, whether the statement of account of theirs got is reflecting that or not. So, it's a highly scalable, highly resilient. We've never been down even on a single day in the last 2 years since the app went live.
The reference of RPA was with respect to operating efficiency. We use it a bit somewhere in our operations processes, but not at that kind of a scale. We like to invest into pure technology rather than RPA. So
automate the full process.
Yeah, automate the full process of the goal, and it's only an in-between bridge, as Anurag is mentioning. So our long term, today itself, RPA doesn't contribute to operating efficiency in the scale at which you might be visualizing.
Okay. Thanks. That really helps. And all the best.
Thank you.
Thank you. And the next question goes to Concall Shah of Citigroup. Concall, please go ahead. Your line is open.
Yeah. Hi. So firstly, with respect to the overall growth momentum, the way you mentioned, first half has been really better. We are seeing almost 17% year-to-date growth. And given the expansion, the investments which we have done, are we more confident that maybe compared to 29-31% guidance which we had given in the last quarter, we should be much more than that, even not only in this particular year, but over the medium term, given that there is fundraise also which is there?
We'll take year at a time. So clearly, can I say, given the strong momentum in the first half of the year, we're pretty confident of the year? The answer is yes. The long-term guidance that we provided, do we remain confident of delivering that? The answer is yes. Anything over and above that, Kunal, we're here to work hard to deliver, create value for shareholders and to dominate financial services. That's one of our ambitions, right? So, if you're doing well on the credit side, if operating leverage is playing through, we can continue to deliver the hurdle rates of ROA and ROE, and we have sufficient capital. The answer is yes. Just on a separate note, and I didn't make that point earlier when the question on leverage analysis was asked, we've seen tremendous amount of competitive activity as part of the leverage analysis. That point also clearly came through. That we used to have a 7.5% share of the personal loan market in India. And that remains at 7.2% even now. This is despite so much intense competitive activity between FY20 and FY23. We've seen less than a 25 basis points reduction. And that is because we've tightened the screws. Because our ratios run at 20% of the industry in terms of the operating performance. We remain reasonably excited about all our lines of businesses and have market share goals for each one of them. And we are in the right place to ensure that we can leverage that.
Sure. And we never had the instances of inorganic opportunity earlier, but now given that we are spreading, given in terms of the... No, we haven't had the instances of... Hello? Yeah, can you hear me?
A little better, but earlier I could not hear you at all.
Yeah. No, so I was saying we never had the instance of inorganic opportunity, but now the product bouquet has also diversified and we are getting into the newer segments. So still, would we keep the stance of maybe growing everything organically, or will still evaluate anything inorganically to achieve the scale or maybe to build the businesses?
In general, on the lending side of the business, purely organic. We have the time, we have the long-term orientation. We at least feel that building lending businesses organically is a better way to go. So in the lending side of the business, purely organic. The answer is, that doesn't mean never say never. Maybe someday, but at least not in the near-term horizon.
Sure. Okay. Yeah. Thanks a lot.
Thank you.
Thank you. And the next question goes to Shubhranshu Mishra of Phillip Capital. Shubhranshu, please go ahead. Your line is open.
Hi, Rajiv. Hi, Sandeep. So, two quick questions. The first one is, as and when the housing finance company gets listed, how do we look at the structure of the listing? How much would Bajaj Finserv own and how much would Bajaj Finance own? That's the first. Second is that we have alluded to market share gain of almost 4 to 5% in our LRS from 1.7% here. So if we can go segment by segment and chalk out in which particular segments we're going to gain market share in the which is the 5-year rolling plan. Thanks. These are my two questions.
Data dependent. Point is one. We would like to grow all lines of businesses, including B2B. If our market share, let's say in B2B is 50% plus, we would like to grow that as well. Let me make that point. I earlier just made a point that if our market share as a company in personal loans is 7.2, 7.3%, we would like to grow that as well. So subject to data dependent, being defined as if the credit is holding, we would grow the business. If credit is not holding, we would not grow the business because we are in a credit business. All lines, Shubhranshu, remain in high growth. As you can see even from the press release, the growth and the mix, largely you take even 3 years or 4 years, has remained steady, adjusted for plus minus 1 or 2%. If you go to, let's say, in the presentation on portfolio mix, that would be, you look at the growth rate for the second quarter, right? Two-wheeler, three-wheeler, 63 because 10% of that growth is non-captive now. So if it was captive to captive, it would have been a 50% growth. 12% growth is non-captive, so that's a new line of business. If you go to panel 45, you see year-on-year growth, 39, 29, 37. Rural B2C we talked about, it's we who pulled back, 38, 46, 28. So there's tremendous opportunity in each one of these lines. The composition is the another thing to look at because this is plus minus the composition that gives us the hurdle rate of ROA and ROE. So if this shifts significantly, which it is not expected to shift from a business model standpoint, this is really where the corridor is plus minus 1 or 2%. So growth rates are strong across. Number one, composition has remained largely here for I would say 4 years already, plus minus 1%, maximum 2%, and this is really what the composition ought to be, plus minus 1%, and we just play along.
I think, Shubhranshu, as we've always said, the diversified financial services model allows us to slow down a particular business, probably accelerate a particular business based on, as Rajiv says, data dependency. As you look at two-wheeler, three-wheeler is showing very strong read on portfolio quality, 94.5% portfolio quality we have never seen in that business.
Never.
that is now growing at 63%. In the same vein, similar high margin business like rural B2C, but the data is not allowing us to grow. We are growing at 17% on a YY basis. I think 12. Yeah, 12% in the second quarter. So I think we do look at the business with data in mind in terms of incremental grade. Based on that, we push forward, we pull back depending on the stance of the business.
And the first question, the structure of Bajaj Finance listing as an outlet.
Your question is on listing of BHFL. I think Rajiv has called it out a couple of times. It's 8 quarters away from now. We have requested, and as it has been put out in paper as well, in some way, we would like to request for an extension, if possible. However, if it doesn't come, then of course we'll work towards it. What the structure will be, how the listing will take place, etc., are something that are not known. It's too far at this point in time. I think strategy will evolve over a period of time on that as well.
Right. If I can just squeeze in one last question, what is the revenue of Pennant Technologies as well as Snapwork, which is driven by Bajaj Finance today, and how does it look like 3 years from now?
So last year when we acquired Snapwork, turnover 37 crores, this year it will be 60 to 63 crores. They're a well-run, small business, but well-run, build mobile applications for most financial services players in India. So, and we're helping him shape the business, grow the company. Finance this year.
What's our contribution in both? That is my only question.
30%. When we bought it last year.
30% in each?
Yes, 30%. No. Of Snapwork, 35%.
Yeah.
And
Pennant is also in 40%.
Yeah, 30% and BHFL. Yeah, both BHFL and as BHFL put together, another 30-35%. But they're now winning. Pennant as a company is winning contracts with the largest of the guys now in India. So they're now clearly the lending platform to go to.
That's right. So for Snapwork, like they're expanding international markets, so this percentage is expected to go down. Our contribution to the overall revenue for Snapwork is expected to go down, and we see next 12 to 24 month period, the percentage will be between the range of 20 to 25% for Snapwork. And as we've just invested in Pennant, and they have plans to expand internationally and invest further on their roadmap as they take the product internationally and more deployment in the domestic market.
Just to call out a word of caution, Pennant, we have signed a binding term sheet. Investment will take, so I think investments are subject to final negotiation and so on and so forth that will take place of terms and conditions, shareholder agreement and so on and so forth. We expect to complete everything by 30 December. 31st.
Understood. This was very helpful. Thank you so much.
Thank you. The next question goes to Ashish Sharma of Enam Asset Management. Ashish, please go ahead. Your line is open.
Thanks for the opportunity. I'm not sure if it is repetitive. Rajiv, so just your comments on I mean, we've heard that regulator has been mentioning of late being little concerned on the growth on unsecured loans. I think in the press conference they had clarified they are concerned on the growth part only. But what's your sense of the noise around the unsecured loans?
Well, it's moderated. The growth, as we are now tracking, as I said earlier, we're tracking bureau data every month. It's moderate. I think there is reasonable moderation in terms of AUMs and disbursement, not so much on count as yet. I think that's the only added point I would make. So in terms of values, there is moderation. In terms of year-on-year growth rate on AUM, disbursement, both there is moderation, but on count there is yet to be full moderation. But as the new FLDG guidelines kick in, which have kicked in, what RBI announced 2 months ago, I think, should moderate that as well. I think it is a great step in, and that should significantly moderate that number as well. Yeah.
And in case like what we are hearing in terms of preventive action, the raising of risk weight limits, does that there would be some impact on the profitability, but overall it doesn't sort of change anything. From a overall profitability.
No, as Sandeep said earlier, that we have levers. There are what we call scale builders in our business and profit builders in our business, and they're not one or two. There are multiple in each line. We just orchestrate. That's really what we continue to do on an ongoing basis. There are clearly, and we've demonstrated that, I would say, to be modest successfully over time, that we don't push what should not be pushed, and we pull what needs to be pulled. So, that's really what we intend to continue doing.
Perfect. And just lastly on BHFL, so we will be raising 10,000 crores. So do we need to even infuse over the next 12 to 24 months in BHFL, to anything above what we have already invested?
Yes, answer is yes. We like to run businesses on low leverage ratios, build a good quality business with low leverage. So even a mortgage business, which today, if you take the second quarter, is at 22 basis points, GNPA is 22 basis points? 24 basis points and 9 basis points. We don't go by capital adequacy. The rightful metric is leverage. So our internal hurdle rate is 7x leverage. Even for a mortgage business, 6.5 to 7, as Atul is saying. 6.5 years there. We are at 6.5. So 7x leverage is what we have internally defined to be the rightful leverage ratio, even for a mortgage kind of business. So we are we committed to continue to invest in the business to build it out? Answer yes.
Perfect. Thank you, Rajiv, and all the best for the next quarter. Thank you.
Thank you. That's all the questions that we have time for today. I would now like to turn the conference back to Mr. Iyer for any closing comments.
Thank you, Rajiv, Sandeep, Atul, Anup, Rakesh, and Bajaj Finance team for your time and insights. Wish you all the very best. Thanks everyone else for attending.
So much. Thank you for patient hearing. Thank you. Good night.
Thank you.
Bye-bye.
Thank you. On behalf of Morgan Stanley, that concludes this conference. Thank you for joining us, and you may disconnect your lines.